Here's something that happens all the time in business, in investing, in negotiation. Someone presents you with a deal. You think it looks solid, but then you find out that same exact deal was pitched to someone else and it looked completely different. Same numbers, same terms, wildly different reactions. By the end of this video, you'll know exactly why that happens, and more importantly, how to spot it before it costs you. The last piece is the part that nobody teaches, and it will change how you see every proposal that crosses your desk. So grab a drink, settle in, and let's get into it. The first thing you need to understand is that how a deal looks depends entirely on what's around it. Think about it this way. If I tell you an investment returns 8% annually, that sounds decent. Now, if I tell you that same investment lost 12% last year, but is projected to gain 8% this year, it sounds almost like a steal. Same 8%, completely different picture. That's called context framing, and it is one of the most powerful tools in any negotiator's toolkit. Here's where it gets real. In 2019, a mid-sized tech company we'll call Meridian Systems was shopping for a new customer relationship management platform. They got 3 pitches. Vendor 1 led with price. Their platform cost $42,000 per year. Straightforward. A little pricey, but the feature list was solid. Vendor 2 led with time savings. They showed that the average user on their platform saved 90 minutes every single workday. 90 minutes times 260 working days times the average employee hourly rate. The math worked out to roughly $80,000 in annual productivity value. Same platform, same price. But vendor 2 made $42,000 feel like a net gain of $38,000. Meridian chose vendor 2. And honestly, from a pure value perspective, they probably made the right call. But here's what they missed. Vendor 3 never got a chance to pitch. They would have led with implementation risk. Their system required 6 months of integration with Meridian's existing infrastructure, required 2 full-time IT staff dedicated to the project, and carried a 30% chance of scope creep that could push the final cost to $65,000. Vendor 3 wasn't worse. They were just honest about the downsides up front. And because nobody heard that pitch, Meridian signed with vendor 2 and spent the next 14 months dealing with integration headaches that vendor 3 had literally warned them about. Same deal, completely different picture. And Meridian only ever saw one version. If this is landing for you, hit that subscribe button. I put out videos like this every week, and the next one is going to build directly on this. Now here's where most people stop, and this is where we go deeper. The same deal can look different, not just because of framing, but because of who is framing it. In 2021, a commercial real estate investor named David Chen toured a mixed-use property in Austin, Texas. The seller had an asking price of $4.2 million. Chen's agent ran the numbers and came back with a simple offer, $3.8 million. Straight deduction based on comparable sales in the area. The seller countered at $4.1 million. Standard pushback. But here's what happened next. Chen happened to mention the property at a real estate investment meetup. One of the other attendees, a developer named Sarah Martinez, had been looking at the same building. Martinez's agent ran a completely different analysis. They looked at the zoning variance that was sitting in the city's approval queue, the potential to add a 3rd floor using an existing structural footprint, and the projected rent premium for Class A office space in that specific corridor. Their offer came in at $4.3 million, above asking price. Same building, same market conditions. But Martinez saw a development opportunity that Chen's agent never even mentioned. Chen walked away thinking he had dodged an overpriced deal. Martinez closed 8 months later and had already leased the 3rd floor at a rate that put her return on investment at 19% annually. She didn't outbid Chen. She outvalued him. And the lesson here isn't that Martinez was smarter. It's that the deal looked different to her because she had a different lens. A lens built from experience, from networks, from looking at properties every single week for a decade. That brings us to the 3rd piece, and this is the one that actually matters for you. How do you see past the presentation to evaluate the actual deal underneath? Here is what you do. Every single time someone pitches you something, you ask yourself 3 questions before you react. Question 1, what are they leading with? If they lead with return, they're trying to excite you. If they lead with cost, they're trying to anchor you. If they lead with ease or speed, they're trying to reduce your perceived risk. None of those leads are bad, but each one tells you what they're worried you won't see on your own. Question 2, what are they not mentioning? This is harder. It requires you to sit with the pitch and ask, where are the gaps? In that Meridian Systems example, what nobody asked was what happens during implementation. What nobody asked was what the failure rate was for clients in their industry. Ask the question even if you don't know the answer yet. The act of asking out loud changes the conversation. Question 3, Who else has seen this deal? This is the one most people skip entirely. If someone is pitching you an investment opportunity, ask directly, who else has looked at this? If someone is presenting a partnership, ask, who turned this down before me? In 2018, a retail chain we'll call Redwood Commerce was approached by a private equity firm offering a buyout at $9.50 per share. The deal looked generous. Stock had been trading around $7.25. That was a 30% premium. But one of Redwood's board members made a call to a competitor in the same space. That competitor had been approached with the exact same offer 6 months earlier and had declined because their internal analysis showed the real estate portfolio alone was worth more than the offer price. Redwood used that information to counter at $11.75. They closed the deal 18 months later at $11.20. Same deal, same numbers. But one board member asking one question changed the outcome by roughly $3 million across the shareholder base. That one shift could save you more than the first two methods combined. So here is where we land. The same deal looks different depending on framing, depending on who is looking, and depending on what questions you ask before you respond. The good news is you don't need to become an expert in every field to protect yourself. You just need to get comfortable asking the questions that change the picture. What are you leading with? What are you not mentioning? Who else has seen this? Those three questions won't make you an expert overnight, but they will make you harder to mislead. And in a world where presentation is often optimized before substance, that is a massive advantage. If this video gave you something useful, share it with someone who needs to hear it. A colleague, a friend, anyone who makes decisions based on how things look rather than how they actually are. Hit subscribe and come back next week. I've got something even better lined up on negotiation tactics that build directly on this. You'll want to see this one.